For millions of Southern California homeowners, insurance is becoming harder to afford as rates soar.
Some are even being told their policies are no longer being reviewed by a person, but by an algorithm. KTLA's David Lazarus has details.
Well, it's not fair. It's not fair. None of it is fair, but I'm one guy. I can't do a whole lot besides pay the premium and say, thank you for another year, State Farm.
Hit me again, please.
Yeah.
Meet Santa Clarita residents Paul and Cheryl, who asked that I only use their first names for privacy reasons. Like many Southern California homeowners, they've seen their insurance rates steadily climb over the years. When they moved into their current 2,900 square foot house in 2014, State Farm charged an annual premium of less than $1,200 for a policy with a $4,000 deductible. A decade later, that premium had jumped to more than $4,000. Then came the LA fires. Paul and Cheryl's premium soared to more than $6,000 this year, even though the couple raised their deductible to $16,000. And even though they improved fire safety by cutting back foliage and using fire-safe materials.
Here's Paul and Cheryl doing what they have to do, and they're not going to meet you halfway?
No discount at all.
And that, he said, was due in large part to his insurance broker informing them that their policy is now overseen by AI, not a human underwriter.
They don't know me. That personal touch is gone.
So Jake from State Farm is now Robo from State Farm.
Robo State Farm, right.
It's a challenging situation for millions of California homeowners now experiencing huge spikes in annual insurance costs. State Farm, California's largest residential insurer, raised rates by an average 17% last year after paying more than $5 billion in fire-related claims. That followed an average 20% rate hike the year before. The company, like other insurers, cut back on writing new policies in recent years. State Farm declined to discuss a specific policyholder's situation when I contacted them about Paul and Cheryl's premiums soaring by 400% since 2014, despite a quadrupling of their deductible. But the company said in a statement that while it understands how frustrating higher rates can be for homeowners, increasing wildfire risk and rising repair and rebuilding costs make higher premiums unavoidable.
It is extraordinary, but we are in an extraordinary market now in California. These are unprecedented times.
Amy Bach, executive director of the advocacy group United Policyholders, said insurers typically lump homeowners together in specific areas, even if a home like Paul and Cheryl's doesn't represent the same risk as nearby homes atop canyon ridges.
And that allows them to put surcharges on the rate that are driving it up in that way.
Bach advised shopping around for better deals, bundling home and auto coverage, and boosting deductibles to lower premiums. Although Paul and Cheryl show that that doesn't always work. For many people, especially seniors living on fixed incomes, higher insurance costs mean having to make hard choices. As Paul said he told his State Farm agent after their premium topped $6,000.
I got 5 grandkids. I said I wanted to take them to Disney World. I said, after I got your policy, the premium, had to pay it. I told 3 of them they can't go. I can only take 2.
He was kidding, but only sort of. David Lazarus, KTLA 5 News.